What's happening, everybody? It's your boy Kreative. Go ahead, say it with me. We are back at it again to do what? To create something great. Now, today I'm super excited what I have planned for y'all today. We're going to be dropping another episode in our KreativeU series where we're going to be talking about calls, right? So we can understand what is a call contract, how does it work, how to actually place one, and we're going to be bringing on our call bot that we created to be able to actually place the call contract. So if you haven't already, I need you to go ahead and smash that like and subscribe button. So let's go ahead and jump in. So this is a script that I created using Python in order to go over this. And we're going to be breaking this down lesson by lesson and also having a few questions so we can check for understanding. So let's go ahead and jump into it. So block one is going to be talking about the right. So a call gives us the right to be able to buy a stock at a locked price. And more on this locked price a bit later because that locked price is going to be our strike price, right? So a call gives us the right to buy a stock at a strike price. Right. So a call is a contract that gives us the right, but not the obligation to buy 100 shares. So why is it 100 shares? Because when you buy one option contract, for every one option contract, it equals 100 shares. And we're buying that call contract at a specific price. That specific price is going to be our strike price. Okay. Now, what we wanted to happen, we wanted to be able to profit before a specific date. That specific date is going to be our expiration date. And in order to purchase this call contract, right, we need to be able to pay a premium, and this premium is for the right in order to purchase the call contract, right? So why would anyone purchase a call contract? We think that the stock will go up, so we're bullish on SPY, right? And SPY is the S&P 500, the top 500 companies within the New York Stock Exchange. So instead of buying 100 shares of SPY at about 550, so that's 55,000, we can buy one call contract for maybe $300 to $500, right? So key here is leverage. We control $55,000 worth of stock for a fraction of the cost with option contracts, and specifically what we're talking about here is call contracts. So here's the payoff at expiration. So here's our stock price, right? So here's our upside potential. So this is for any option contract, you have a limited upside potential, but our downside is limited to what we pay the premium, right? So in essence, this is our downside. Our max loss is going to be just above our downside. So instead of losing the entire 300 in this example, right? So maybe we'll set our max loss to 280, right? Or 275. So a 25% stop loss or max loss, right? So our stock price is going to be, whenever it goes up, we're going to be profiting. Whenever it goes down, that's when we need to be able to watch our max loss limits, right? So a live example, we have a SPY's the S&P 500, the top 500 companies within the New York Stock Exchange at 674 call. The premium paid was 289 or $289 per contract. This gives us the right to buy SPY at 674, even if it goes to 600, 700, or even higher. Right, so our break even is going to be the 676.89. We must exceed this to profit before our expiration. The max loss is going to be the premium you paid, and then the max gain is unlimited, right? The higher SPY goes, the more potential we have in order to profit. So a call contract gives us the what? The right to sell. I don't think so. Is it buy? I think that sounds familiar. Or is it hold a stock at a strike price? So it is going to be buy. So SPY is at 674. We buy a 679 call for $3 or $300, right? Because for every one option contract, there's 100 shares. What is our max loss? So the max loss is going to be our premium paid. So the premium paid in this instance is going to be the 3 times 100, or it's going to be $300, right? So it's not going to be the strike price, because that is the price that we're betting that SPY goes above, right? Because we're bullish on the market. So it's going to be our premium paid, which is the 300. It's not going to be unlimited. That will be crazy. There are some instances where it's unlimited, but that we're talking about shorting stocks. We're just keeping it super basic. We're talking about long calls, because we're bullish on the market, right? So we are going to put B here. Why do traders buy calls instead of just buying these stocks? That's an interesting question. Calls are safer than stocks, not always, right? That's one of those estimations. That's not really a good answer here. Leverage. I think I heard that before. Control more shares with less capital. Calls never expire. I wish. So just by process of elimination, it is going to be leverage. Let's go ahead and go to our second block. The second block is going to break down the strike price. So your target price, where action starts to happen. So the strike price is our target price. If the price is where call becomes valuable. The current price of call is 673.61. Now there's 3 types of strikes, right? Now we have in the money, or ITM. This is the strike below the current price, already has real value, more expensive. We have ATM at the money. This is the strike at the current price, balance risk reward. These are the most liquid, right? Then we have OTM. This is the strike above the current price. This is cheaper. We need bigger moves in order to profit. So when you hear ITM, you're thinking of, okay, somebody's purchasing an option contract that is below the current price. All right, bet. So I got what ITM is. When you hear ATM, this is when we're purchasing the option contract at the current price, right? So bet, I know what ATM is. Now, OTM is where we're purchasing the option contract above the current price. All right, bet. So we got OTM. So a live look at the strike ladder for SPY. And again, SPY is the S&P 500, the top 500 companies within the New York Stock Exchange. So the current price of SPY is 673.76. So being able to buy below, we know that below is ITM, and it's going to be a lot more expensive because now it's already profiting, right? So we can see here the ITMs are the ones that are more expensive, already profitable, very expensive, right? Then we have quite a few selection of ATM. ATM, remember, this is at or near the current price, right? So our ATM selection, we have quite diverse, anywhere from $152 to $321. Now, how did I get to that? Remember, for every one option contract, it equals 100 shares. So whenever you see the ask price, and why are we using the ask price? Because the ask price is what we use when we want to get into the market, right? You pay the bid price when you want to clear it, when you want to get out the market. But when we want to get into the market, that is going to be the ask price. And I'm going to be making a video breaking down an ask and bid because I think that deserves its own. But nonetheless, so the ask price when we want to get into the market, so we're going to take the 321, multiply that by 100, and that's how we get $321. So the range for ATM is anywhere between $152 and $321. Not that bad. It's depending on how your algo is set up. Then we have OTM. Now OTM is what? Above the current strike price, right? So our range for OTM anywhere between $80 and $112. We need big moves in order to profit when you're OTM. So think about it this way. ITM, it's like a 1-for-1 move of the option price and the stock price, right? And it's also depending on the delta as well, but more on that in a bit, right? So you're going to have almost that 1-for-1 move when you have your ITM contracts. ATM contracts, I mean, almost like 3/4, 0.75 to almost like 0.80, maybe like down to 0.60 of a move for that strike price, right? And then OTM, these are going to be your home run hitters, your lottery tickets, right? So you need a lot more moves here in order for it to be profitable. I wanted to spend more time there so we can understand it, because you are going to see ITM, ATM, OTM a lot when it comes to option contracts, and I hope that gave you the breakdown, right? So below, that's why we have it here, current SPY price. And this is based off February, I'm saying February, I'm tripping. March the 6th, it's about 12:30 in the afternoon EST, whenever you're watching this. So the current price of SPY is 673.81, right? How do I know that? I'm looking at TradingView. Let me go there real quick. And TradingView is a platform for free, if it's free for me, where you can be able to gauge and look at different assets. Right now I'm looking at SPY, and we're looking at it live, right? And the current price is at 673.92, and I'm looking at it on the Bollinger Bands. And the reason I like to use Bollinger Bands is because we can be able to gauge volatility. So let's go back to our work we're doing here. So ITM is going to be below the current price. This is deep and near ITM. And then ATM is going to be at or near the current price, the 674. And then OTM is going to be above the current price. And we're talking about calls here. So more expensive, but more safe, cheaper, but riskier. So that's the scale that you're looking at when it comes to ITM, ATM, and OTM. So let's jump into our quiz. So SPY is at 674. We buy it at 664. A call. So this would be ITM, OTM, or ATM. So we know OTM is above the current price. So if the current price is 674, but we're buying at 664, it's not OTM because we know that's above. ATM, we know that's at or near the current price, so we know it's not that. ITM is where we're at because that is below the current price. Gucci. All right, so let's go ahead and put our answer. So SPY is at 674. Which contract is going to cost the most? So let's think about it. We're buying it below the current price or buying it above the current price. So buying it below the current price, we know that ITMs are a lot safer. And if you're paying for safety, you're going to be paying for it as well, right? So just by off that, we know that ITMs are a little bit more expensive, not a lot more expensive than OTM, and they're not going to cost the same. I just throw you off there. So it is going to be ITM. You want cheap, high risk lottery ticket option contracts. Which strikes would you pick? Deep ITM, far below the current price. I mean, it's depending on how you look at the market. I wouldn't say that's your best bet there, because you already told me what you wanted. You want a cheap, high risk lottery ticket. So ITM is not going to be that because this is below the current price. ATM is at the current price, right? So it's not going to be, it is still high risk. So all these option contracts are still high risk, right? But it's these extra adjectives that you're using, cheap and lottery. So it is going to be a deep OTM above the current price that we're going to do. All right, so let's go ahead and jump into our next lesson, which is going to be expiration. This is the countdown clock when your right expires. Right at this date, the call disappears, gone, worthless if OTM, right? So common expiration types, we have 0 DTE. These are the option contracts that I normally trade daily. All of our bots are trading 0 DTE, but let's keep going. So 0 DTE are option contracts that expire the same day, extreme risk, extreme moves, day trading only, right? Weeklies are option contracts that expire this Friday. High theta decay. And what is theta? This is just the cost of being able to hold the option contract. Think of it like this, an ice cream cone that's melting, right? So as soon as you put your first scoop on there, it is melting from that start. So that's that theta decay. And short-term bets for your weeklies. And then you have monthlies. These expire the third Friday of the month, more time, but more expensive and steadier. And then we have leaps. These are going to be 1+ year out, longer bets, minimal daily decay, right? But these are going to be the most expensive out of the bunch because you're paying for more time here. So a live look at SPY expiration. And today's the 6th. So these are going to be 0 DTE, expires today, handle with care, right? With care, take care. And then we're going to have our 3-day expiration. These expire on Monday. 3-day today becomes 0 DTE on Monday. And then these are short term. And then our midterm are going to be close to a week to 2-week contracts that are here. So time decay, the clock is always ticking. So 30 days, we're looking at $5, and then 21 420. So as you can see, with the more time you have, the more value that's going to be in the option contract. Less time, you're going to see it almost becomes dust, right? You still have some money, but bro, bar none is nothing for what you pay. So Delta accelerates. Last week loses the most. That's one thing you want to be able to keep in mind. So 0 DTE, what does that mean? Does it $0 to enter? I wish. I wouldn't be mad at that answer. Is it going to be 0 days to expiration? Expires today. That sounds familiar. Or is it going to be 0 theta exposure, right? So which option contract costs the most if all else is equal, right? Is it going to be 7 days to expiration, so weeklies? Or is it going to be monthlies, right? Now, with option contracts, one thing just to keep in mind is you're paying for time, right? So if you have more time on your side, that one's going to be more expensive. And this one's just to throw you off. So with more time on our side, that's going to be the 30 days to expiration. When does time decay or theta hurt the most? 30 days before expiration, the last week before expiration. I think I heard that before. Or decay is constant. It's every day, right? So I wouldn't be mad at this answer, but it's asking us when does it hurt the most, right? So it's the last week of expiration. So now let's talk about our premium, right? So the premium is going to be what you pay. This is going to be the intrinsic plus the extrinsic, right? So the premium is the price that we pay for the option contracts, and it's made up of 2 parts. The first part is going to be the intrinsic value. This is going to be the real stuff. The next part is going to be the extrinsic value. This is going to be the hopes and dreams and time, right? So intrinsic value is going to be the real money. This is going to be the actual profit built into the option right now. For calls, intrinsic equals you may see this again. Intrinsic equals the stock price minus the strike price if positive. If negative, intrinsic is 0. It can't be negative. So extrinsic is hope, money. This is our time value, right? So what is an option price made up? It's made up of 2 things. Our first thing is going to be our intrinsic value. The intrinsic is going to be the stock price minus the strike price. If it is positive, if it's negative, it goes to 0 because intrinsic cannot be negative. And then our extrinsic value is going to be the hope. You pay for the possibility of future movement. This melts as expiration approaches. So key takeaways, ITM is intrinsic plus extrinsic, real value plus time. ATM is going to be mostly extrinsic, small or no intrinsic value. And then ATM, OTM, out of the money contract is 100% extrinsic. So we have our SPYs at 674. That is our stock price, right? And a call is our strike price is 669. So 674 subtract 669, that is 5. So $5, right? It cost $7. What is the intrinsic value? The intrinsic value is going to be the stock price minus the strike price. So it is going to be that $5 here. And OTM cost $150 or $150. How much is intrinsic? How much is extrinsic? So we all know it told us the answer. OTM is 100% extrinsic, all hopes and dreams value, all time value, right? So our answer is going to be C. What happens to the extrinsic value as expiration approaches? It increases. It stays the same. It decays to 0, right? So it is going to be that decay. So let's quickly go over our Greeks. Our Greeks is your dashboard, how the call behaves, right? So the Greeks tells you how the option will move. So delta is going to be the directional exposure. This is how much the option moves for per $1 stock move. So a delta of 0.5, option gains $50, right? When the stock moves $1. So per contract is going to be, I said $50 is 50 cents, but per contract is $50 per $1 gain, right? Now, delta also tells you the probability of profit, meaning that this option contract has a 50% chance for expiring in the money, right? To be able to make your money at or near the money, right? So that's what the probability of profit is telling you. So delta is telling you, okay, the direction of exposure, how much is the option is going to move per $1 movement, but it's also telling you the probability of profit. What is the percentage of this option contract expiring at or near the money, right? And this is a 50% chance. Theta, we already talked about this before, is our time decay, is how much option loses per day from time passing. So theta of negative 0.5, we're losing $5 per contract per day just for holding onto it. Now, theta is always working against option buyers, but option sellers love it because you're collecting premium. More on that a little bit later. Gamma is going to be our acceleration, so how fast delta changes as the stock moves. So high gamma is delta grows quickly as you win. It's almost the snowball effect. And then Vega is how much your option moves 1% in IV. Critical before earnings. IV crush can destroy your trade. So here's a live look at our option contracts, now a little bit more delineated. So we can see our delta of 0.78, right, or 78% chance of this option contract being able to expire at or near the money. Or for every $1 move, this option contract is moving $78. It has a gamma of 0.30, theta of 2.38, right? So we're losing, yeah, that's a lot. I'm not gonna hold you. Losing almost $200 just to being able to hold this option contract per day. And then we have our Vega. So ATM, a little bit balanced, and then OTM, low delta. So we're going to need a little bit more bigger moves for this to be able to expire at or near the money. So here's a little quick cheat sheet. So delta of 0.5 plus the stock moves of $2 equals $100 per contract, right? So we're going to take the 0.2 times 2 because the stock moved $2, then multiply the number of shares that we have in the option contract, because we know that with every one option contract we have 100 shares. Theta of negative 0.8, you lose $8 per share a day. And then high gamma plus stock moves your way, delta grows and accelerating gains. But high Vega plus IV drops, your option loses value. Just got caught in an IV crush. So your call has a delta of 0.60. The option goes up $3. So we're going to do 0.6 multiplied by 3. That's 180. That's, yeah, 180. 180 times 100 is $180. How much do we gain per contract? Okay, so it's saying per contract. It's 60 times the delta. How much did we gain per contract? So it is going to be the B. Beautiful. I just overthought myself. That's just, when you know the answer, just answer it. My fault. Theta is negative 0.10. What happens to your option contract overnight? Oh, you just made money. I wish. You lose money, right? That negative just told you, and just multiply it by 100. You bought a call before earnings. That's questionable. And the stock moves 2%, but you lost money. Why? Right? We just talked about it. And it's an IV crush, right? You better be really careful being able to trade earnings, bruv. And here's a live look at the option chain, right? Where we can, all of it comes together, right? So we're looking at ITM. We know ITM is below the stock price, right? And we're seeing here, yep, the most expensive ones here. But we're seeing with the highest delta, right? Because it's already at or near the money, right? You're profiting. You have the intrinsic value that's there already, right? And the extrinsic is what can be able to be gained, right? And another thing I want us to be able to look at is our ATM. Our ATM is probably going to be making up. I mean, I want to say OTM. It's all depending on how you're looking at it and how deep you're going. Right now, I think we're going about 8 deep. 1, 2, 3, 4, 5, 6, 7, 8, 9. So 9 strikes deep, and we can see we have 2 ITM below, ATM at or near, or OTM at or above, right? So how to read the bid is what you can sell it for. So when you want to get out of the contract, the ask is what you're going to buy it for. So when you want to get into the market, and then the spread is going to be the difference between the ask and the bid. So this is going to be the immediate cost for us to exit or enter. And we definitely talk about spreads or slippage, right? So that's one thing you definitely want to be able to keep into account. I think I'll make a video specifically on spreads and how to be able to account for it, because that's one thing that I noticed previously. It was like, all right, bet as soon as I get into a trade, I could be down 3-4%, right? So I need a lot bigger of a move in order just to make up that 4%, and especially to go which way we're betting on the market. But more on that a little bit later. And then delta, the dollar gain per stock moves, also the rough chance of ITM, and theta is how much money you're going to be losing per day. And IV is implied volatility. The higher is more expensive. And here's a selection of an option contract. So what I want to do now is actually go to our call bot, and we're actually going to run it so we can see how to be able to do this live, right? So what it's going to, oh yeah, that's dope. I forgot to bring in the conda environment. I thought I did, but I didn't. My fault. I'm going to copy that. Clear, Python. There we go. All right, bet. So what we're going to do, hi, I'm your call trading assistant. Let's make some moves. It connected to Alpaca. This is our buying power and the market is open. We're going to be buying SPY. And then how long are we going to hold it? For 44 seconds. Our profit target, let's say 3%, because it is the afternoon. I'm expecting some chop. So I don't know how well this is going to work. Let me just take a peek at the market real quick. Oh, okay, the market, I think this is going to be a bit of a bet because it is moving back to its average. So I think this way work out for us. So let's go back to our code. 3%. Let's give it 18. Boom. Reject. All right, go ahead and submit. All right, I submitted the order. Now we're in it. You heard that sound. I just have another file that whenever an order submits, I can keep track of it so we can see. So now we're going to be holding it for 44 seconds. So let's see if we can catch this little bullish trend that's happening right now in the market. So this will be interesting to see if we can catch that. And I'm pretty sure we can, bruv. Like the market is pushing up. I want us to be able to see if we can catch that. It just turned. I believe in you though. See? We're catching this little upward bend right here. Perfect. All right, come on. Give me green. All right. I mean, we ended flat. So that's dope. So that's it, folks. So I hope at the end of this, you're able to understand how a call contract works, the different intricacies of it, and seeing us how to being able to go through a trade live in the market yourself. So if you haven't already, I need you to go ahead and smash that like and subscribe button. It is your boy Kreative. I'll be back at it again with another episode.